Hello and welcome to Pro Trader Strategies. One thing I want to mention before we get started here is watch this recording again, especially if you're a newer trader. We're going to be kind of breaking down a lot of the nuances with this particular strategy. So it's going to be really important that you guys go back and watch this again. One reason is when you guys are watching this the first time, a lot of things are going to blow by you. You're going to be thinking about maybe some questions to ask, and you might miss some of the nuances that we're talking about. And even for the savvy traders, yes, the savvy traders, exactly, John. This is going to be even appropriate for savvy traders. I know that you guys can go out there and figure out how to buy a long call, but I have specific rules in and around just going out and buying a long call to increase your probabilities of success, and certain environments that you need to have in and around this to make sure that you're setting yourself up for success. Being mechanical, that's something I teach in all of these webinars. So watch it again. It'll actually make it stick into your long-term memory if you watch it relatively soon. If you watch it a month down the road, you're going to basically be relearning this all over again. So the sooner the better. But let me get on. This is going to be options for beginners and even savvy traders, like I mentioned, on the long call. But let me get a couple of things out of the way really quick. My name is Eric Wilkinson. Some of you guys may recognize me from CNBC, Fox Business, or the Wall Street Journal for commentary on everything from economic to geopolitical and market analysis. Believe it or not, I actually started trading in college with some money I had earned. We had a family farm, and I worked on that ever since I was like 12 years old, and driving tractors and whatnot. But some of that money, I saved it up, and when I got to college, was going to do a psychology degree, and then a banker approached me and said they had a discount brokerage unit, and I could start investing in some stocks with that money. So started to do that, and midway through, actually about a year and a half into my college career, I switched it over to finance. And then after graduating college, I moved up to Chicago and started working on the Board of Trade. I actually started out as a runner, one of those little guys that run up, hand paper into the pits, and then sold all my stocks and ended up buying my badge. So the options badge is this badge right here, this little green one. The futures badge that I would trade Fed funds with, or E-mini S&Ps and stuff like that, is this black one. So I started trading all of those things. I actually started even trading options in college, in and around some stocks, doing covered calls and things like that. So anyway, in that time, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all these products, basically in all market conditions. So I've been there, done that. I've seen it when it's really slow, and I've seen it when it is manic fast. So the markets were a blast down there. Yeah, so this was I believe this was a unemployment number, which we used to call the unenjoyment number, Steph, on the floor. So that was a pretty busy day. All right, any opinions, news, research, and analysis, or other information or material provided by Pro Trader Strategies and associated companies is provided as general commentary and does not constitute investment advice or solicitation to buy or sell any of these securities or strategies. The reason why I can't give you guys a trade recommendation is because I don't know what your risk parameters are. I don't know your investment prowess. I don't know what's in your portfolio. So how could I possibly go out there and say, hey, this is something you need to put on. This is appropriate for everybody. That's not the case. So at the end of the day, what we're here to do is to teach you these different strategies, and it's up to you guys to implement those into your portfolios in your own way. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right, you can also follow us on Twitter. You can follow me personally at Wolfman's blog, or our parent company, which is at Pro Trader Strat. You can, during the earnings season, I tweet out a lot of my earnings trades. I don't necessarily give the exact strikes, but if you've watched those webinars, you know exactly where I'm going. I stay mechanical with those. I'm following my rules just like I would expect a newer trader to follow those. And the reason why is because it keeps you mechanical. It makes sure that you are in and out of these trades at the best time appropriate. So stick with that as well. All right, like I mentioned, this is going to be on the long call. But before we get into this, I want to do a little options 101 just for some of the newer traders here. It might be a little bit of a review for some of you older traders. But options 101, we need to know what the Greeks are. And I'm just going to briefly run over these, and then we'll kind of go into more detail as we go along here. But delta affects the options premium in relation to the underlying's first dollar move. Now, if that's up or down, it's going to affect that premium for the first dollar move. So if we pull up this trading platform here, we can look at Pepsi just because it's the one that's up. What I do is look at the delta, gamma, theta, and vega. So the delta for the first dollar move, if Pepsi goes from 116.73 to 117.73 today, this options premium, the 117 calls, are 67 cents. Let's just call it 70 cents for math purposes. That first dollar move up, this premium is going to increase by 43 cents. And vice versa, if it goes down from 116.71 to 115.71, this premium is going to go down by that 44 cents. So if it goes from 70 and market goes down by $1, this premium will go down by that 43 cents. As you can tell, it's constantly changing, and that has to do with, now this is at 116.69. So as the market moves down, this is going to decrease. The other thing we need to look at, so that would go from, so basically, Josh, what I'm saying is it would go from 70 cents and decrease by 43 cents. So that would be 27 cents, right? So if this market goes down by $1, this premium would go down by that 43 cents. And keep in mind, the closer to expiration we get, this is 17 days to expiration here, this delta is going to actually increase. So it's not a constant, if you will. So we could look at something like the 120 strikes on either one of them. This is going to be closer to there. It's not going to be a very good example of that, but you can rest assured the closer to expiration, the ones that are very close to at the money are going to slightly increase in delta. It's going to be a little bit more volatile. In and around that. The further out you go, it's not as much of a factor, but those at the monies are going to move a little bit more. And then the next thing we need to look at is gamma. So gamma is our next Greek. And what is gamma? Gamma is the rate of change of delta. And basically what gamma is it just gives you an idea as to what the second dollar move is, if that makes it a little bit easier for you. So we can look at delta being 43. So the first dollar move that we talked about, it's going to affect the premium by that first delta. The next dollar move, the second dollar move, so we were talking about from 117.70 to 118.70 now. So that second dollar, you kind of add this gamma into the delta for that second dollar move. So if it moved up $2, that first dollar move would affect the premium by that 43 cents. The second dollar move is going to have gamma added into it. So it's going to be closer to 50 or 61 cents in a sense. So the second dollar move, this would go from 70 cents. First dollar move, 70 cents would be 125, let's call it. So it'd go to 125, and then the next dollar move would increase by 61 cents. So that would go to 180. So that dollar would go to about 180 something, off the top of my head. Could probably figure it out, 187 to be closer to exact. And as a matter of fact, you can see that these that are in the money are trading 180, so $2 into the money. So it's going to be close to that. So you can keep an eye on that. It just gives you a little bit of an idea as to what to expect with your premiums. It's not always exact. There's a lot of things that can impact it. Theta can impact it, and Vega will impact it. But we'll talk about that here a little bit more as we go along. So Theta is the impact of time on the premium. So that premium is going to decay daily by the amount of theta. And the closer we get to expiration, theta increases, especially in and around these options that are closer to the money. As a matter of fact, you can see the options that are closer to the money 50 some days out are only going to be decreasing by a penny here, and these options that are closer to at the money are going to be decreasing by about 2 cents. So the at the monies are going to decrease faster in and around the closer to expiration. And I'll show you a chart a little bit better that will give you a better picture as to what theta looks like from a chart. Sometimes people are a little bit more visual. I'm a little bit more visual. So I'll show you a little bit of a theta decay and how it actually starts ramping up the closer we get to expiration once we get down a little bit further. And then Vega is the measure of change in volatility. So keep in mind that volatility is going to affect delta. It's going to affect gamma as well. So the higher volatility goes, the bigger delta gets, because it's a factor of Vega. So when we're selling options premium, we want that Vega to be high, because then we have higher deltas further down the options chain, I should say, or the option montage. So as volatility starts increasing, these deltas get bigger, and it kind of allows us to get more premiums further out here if this were to start increasing. So, but right now, because we're looking at a long call, we want really low volatility, right? Because we're buying something. We want low volatility, and we would love to have the expectation of that volatility to expand. And we also don't want theta, because as a matter of fact, on the floor, we used to call theta the thief in the night that comes and steals your premium. So we want to stay away from theta. We would like to see volatility to increase to offset that theta. And I'll show you a little bit more about that on that same chart that I was speaking of, that you'll get a little bit better visual picture. But if volatility starts expanding, delta starts moving higher, and we could be directionally wrong if volatility starts expanding and still maintain that premium that we bought, because those premiums start inflating as well. So that's why I'm setting this all up, you guys, for what we're going to be looking at when we start getting into my rules. So we want really low implied volatility. Pepsi, as you can see, doesn't have really low implied volatility, so this wouldn't necessarily fit for this long call strategy, but it does fit my rules of everything else that we'll talk about here pretty shortly. All right. Now, one thing with this long call, the directional assumption is very bullish. As a matter of fact, we used to call this like, you need to be more bullish than a matador, because you need that directional move in your favor 90+% of the time. This is a low probability strategy. I'm not going to lie, it's not even one of my favorite strategies, but when you are really bullish on something and you think there's a major outpaced market move in the near future, then this is a good strategy, because it has a lot of reward potential, but it also has a lower probability of success. Low risk is going to connotate lower probability, you guys. So this is a very low risk strategy, in that we're not going to be paying a lot for it, but whenever you don't pay much for something, you're probably not going to get much for that something. So keep that in mind as well. So we're going to be playing that. All right. So the essentials to success with the long call strategy. Now, you guys, a couple of things to keep in mind. Be aware of dividends. because the way we're setting this up with my rules, dividends are generally baked into the cake, if you will. So when we know what the ex-dividend date, and the ex-dividend date is the days the shares are no longer offered with dividends. So that's the ex-dividend date. So basically what happens is the stock price decreases by what those dividends will be. And after the ex-dividend date, those shares decrease by that amount because the people buying that stock won't get that dividend, is really what it comes down to. All right, so a couple of examples here we can kind of go over. If at the ex-dividend date, the receiver of those dividends is going to get like 25 cents, the stock value is going to decrease after the ex-dividend date by that 23 or 25 cents. All right, so if you were able to sell a call option, you would have received the extrinsic value back in cash. But since you are basically not having that stock, that's going to decrease by that. You're kind of, in a sense, paying for it. A lot of it is baked in, but because we're going to be going further out the options chain on the duration, a lot of times that duration will not have the exact amount of dividend baked into the cake there, all right? And something to keep in mind here when exercising, all right? Because a long call, we want this to go into the money, right? Because that's going to increase our value. That means we were directionally right. A lot of people will sometimes say, you know what, I'm deep in the money here. I want that dividend and I want to get paid for that. I wanted this stock anyway. I did this long call spread or long call strategy because I really believed in this stock. I want the dividends. I'm going to hold this for the long term. Now, there's a couple of things that you need to really take into account before you do that exercising of these calls. A lot of people like to do that, but it is expensive and it's not always going to be cost effective to do that. So if you're thinking about exercising these calls, you have to basically look at the extrinsic value of those calls that are in the money, because the extrinsic value needs to be less than what the dividend is that you would receive. All right. So for instance, if we're looking at that same Pepsi, what I'm talking about with extrinsic value, we can look at options that are in the money. And these options that are in the money, since we were talking about buying a call, right? We would want it to go in the money. And if the option goes into the money, there's intrinsic value, which is what this option strike is worth. If you were just to buy the stock outright. So, 14 and we're looking at $2.65. Well, you can add 265 to 14 and you're going to get what's that? 116.70. So 116.70. Now there's extrinsic value. There's not a whole lot of intrinsic value in this particular strike. As you can see, if you add that in, it's pretty close to where we are there on those 114. So play that as well. Sorry, you got that pop up. Anyway, so we want to make sure that the dividend is going to be the dividend that we would receive by owning a stock makes sense. And for you to exercise that ex-dividend and receive, say, a 40-cent dividend, then you just need to make sure that that dividend is more valuable than the extrinsic value. In this case, it would be. But keep in mind as well that if you exercise it, you're going to have to pay like a $15 assignment fee. Now, it's a lot cheaper then to think about, well, what if I just go out and sell out of this option, collect my profits here, and then go out and buy that stock at a lower rate, because the cost is usually around $7 to buy that stock, and trading options is generally cheaper than all of that put together. So weigh those commission costs, how much you're going to have to pay in commissions to get out of this and buy the stock versus the $15 assignment fee. And a lot of times it's cheaper to get out of that stock, go out and then buy or get out of that options, I should say, and then go out into the market and buy that stock to receive that dividend. So play that, keep that in mind to do that math beforehand. So make sure you're aware of dividends. And if we do this out, 80 days, we probably aren't going to know what that dividend is. And the stock is going to decrease by the amount of that dividend once it isn't once it's announced. I'm going to try and price it in pretty close, but it'll become more exact then. All right, picking the right underlying. Now, this is really important, you guys, because the right underlying, everybody can trade a lot of people have heard of Monsanto. Now, look at these markets in Monsanto. They're all over the place. And I talk to people about, with this, picking the right underlying, look at the monthly options that are nearest to expiration. Sometimes you can go out, 40 days, and that'll be a pretty good estimation as well. But make sure that the stock has a tight bid offer. You can see over here on the calls, it's going to be pretty close to my rules. But over here on the puts, you can see it's pretty wide. But my rule for this is any stock under $100, we want a tight bid ask. And in that, a stock under $100, we want the bid to the offer in the nearest expiration month to be less than 10 cents from the bid to the ask on either the puts or the calls closest to the at the money. So just look at these. This is 3 cents wide from the bid to the ask, 4 cents wide. That meets the rule. Now, a stock that's over $100, we want to move the decimal place 3 ticks to the left. So in this case, it would be 12 cents wide. Now, you can see that these options are all over the place and not meeting that rule. Even in the 50 days, 12 cents wide. It's pretty close, but it's not really meeting that rule. And if you get over here, 20 cents wide is just way too wide. And these are 55 cents. And the reason why is because it costs so much to get in and get out of it. Think about it. If we were giving up 20 cents to get into this trade, well, we talked about Theta, and Theta only is going to decrease by 2 cents per day. So that's going to mean you're in this trade for 10 days to get to 20 cents. And you might only be able to get out for a scratch, because then you got to give up 20 cents to get out of it. So, keep that in mind as well. Tight bid ask means there are so many people in there, like even with like an Apple, if we were looking at Apple, it means there's a lot of participation in this particular underlying. And that means that people are willing to give up some edge. You, me, everybody else is in there. This is a stock that's $173. My rule here would be 17 cents wide, and we are at 3 cents wide. So I may only have to give up a penny or two to get into this right away, and I may only have to give up a penny to get out of it. And we're going to see a lot of theta decay. As you can see here, this 6 cents theta decay. So I might only have to be this into a day before I'm looking at being able to scratch that if the market didn't move. So that is really important. So any stock under $100, it's got to be inside of 10 cents. Any stock over $100, move the decimal 3 ticks to the left, and that's how wide the bid ask should be. So, a $300 stock should be 30 cents. A $1,000 stock, it should be $1 wide. All right, and even Priceline and things of that nature. Priceline's been getting a little wide lately, just due to volatility, because the volatility's increased. But you can see $1.75 should be where we are for this particular underlying, and it is inside of that, or it's pretty close to that. It's $2 wide, but volatility in here has been pretty high. You can see here's $1.50 wide, so that makes that rule work. So just keep that in mind. Move it 3 ticks to the left. That's what we're looking for the right underlying. Aon is an example of a stock that everybody has heard of, but Aon will have that really wide bid ask. So It's a $140 stock, so 15 cents wide. We got like 20 cents wide here, 20 cents wide over here. It's close to 15 cents wide. So it's a stock that, sometimes will fit that rule. But when it comes down to it, if you go and look at the volume and open interest, you can see there's not a ton of open interest and almost no volume in here today whatsoever. And the reason why those bid asks are pretty wide is because there's not very many players in here. There's a couple of guys that are making the markets in here, and they probably aren't going to be too lenient on giving up edge in here. So you're going to probably have to, in something like Aon, give up half, more than half to the bid to the ask. So if we look at something like Apple, who is a very similarly priced and even higher priced stock, the higher priced stocks will have a tendency to have wider bid ask. But if we look at Apple, you can see tons of volume going on in this particular underlying. And that means that there's a lot of eyeballs in here. And if I give up a penny on one side, somebody else will probably give up a penny to the other side because they want to get filled as bad as you do. So there is a free market price discovery going on here. Whereas with something like Aon, there's only a few people out there playing in that one. All right, so let's move on to the next essential to success. Picking the right strike. Now, this is important with this one because we're going to be looking at like a 45 to 35 delta. The more wildly bullish I am in this particular one, I'm going to be going out further to the 35 delta out of the money option. For beginners, picking the right quantity is going to be pretty essential. And if you're used to trading 100 lots in stock and you're trying to move over to options, one option is equivalent to 100 of that underlying. So I would trade one lots in this particular strategy. And even if you're used to trading, 500 or 1,000 contracts, and you're just getting into options, I would go a little bit less than that. If you're doing 500 contracts, I'd probably lean towards doing two options, which would be equivalent to 200 of the underlying. And if you're used to trading 1,000 lots and you're just getting into options, maybe somewhere between 3 and 5 would be what I would kind of look at for this one. But picking the right strike, we're going to be looking at the 45 or 35 delta strike. So for that, we need to go back to the delta and the gamma. This is a Thinkorswim platform. It's just one that I've gotten used to and have kind of stuck with. So somewhere between that 45 and 35 delta strike, which is going to be pretty close to out of the money. That's going to be right here at this 175 one. So we're going to be looking at doing Apple. If we were really bullish in Apple, probably picking this 175 strike. Another thing to look at is I also like to pay around $1 for these. So, for me, I might bend that rule a little bit only to get to that only paying $1. But pretty good probability of success. Now, Delta also, for the beginners, will tell you what the probability of this particular strike will be in the money by 1 penny at expiration. So in the next 17 days, this has a 40% probability of having Apple trading at 175.01. 40% probability. Now, a little floor trader hack for you guys that we used to use on the floor is that in this time, that's only settling. Okay, that means at the last moment, this has a 40% probability of being 175.01. That's on expiration day. Now, a little floor trader hack for you. Inside of that 17 days, we have 2 times this delta. So we have an 80% probability of the market coming up and trading 175. So that's pretty good. And now if you talk about, when we add in what delta would be and the gamma and things of that nature, we're talking about a $2 move for math purposes. Let's just call it, okay? So we have a $2 move that we're looking for in Apple to go up to 175, okay? And that's an 80% probability. That's a pretty good probability. So our premiums would increase the first 40 cents for the first dollar, and that would put us at, I'm just going to do this for based on $1.80. So it would be trading $2.20 for that first dollar move. The second dollar move, it's going to be trading, we'll get another 40 cents plus the 6 cents. So another 46 cents added into that premium. So basically a total of 86 cents added into this. So, right? So, yeah, 86 cents added into that. So if we just looked at the 180 for my math in my head, you guys, that would be $2.66 in a sense, somewhere close to that, okay? And if volatility increases, that premium will go up more. If volatility decreases, that premium would go up less given that same directional move. Okay, but we're going to be looking to do this. Apple still has a little bit high volatility percent than what we're going to be looking for any trade today with the long call. We want really low implied volatility. All right, picking the right duration. Now, this is where I was talking about where we're going to be looking at something that gives us a picture of what theta decay looks like. And this is what theta decay looks like on a chart in a sense. You know, the further out, it decays less. And this isn't perfect, you guys. This is just a visual representation based on, you know, a lot of different underlyings and just giving you a ballpark on what theta decay looks like. You know, 90 some days out, very little theta decay. But as you can see, the closer we get into expiration, it starts increasing that slope ever so slightly. So we're going to be looking at out here in time on the duration. We're going to be looking outside of 45 days to expiration on that duration. So as you can see, it starts really picking up inside this 45 days, and inside of 35 days really starts sloping downward. So we don't want that thief stealing our premiums. So we're going to go out a little further. Yeah, you are going to have to pay a little bit more, but I would rather pay a little bit more and have that decay slower to give me more time to be right. And keep in mind as well, with this being a low probability strategy, this gives us more time to be right, whereas we have to be right really fast inside this slope. So go out a little bit further, buy yourself some time, and increase your probabilities. But what volatility does, if volatility goes up, volatility actually starts pushing this out. It holds off theta decay from happening. And that's what we would like to see, is volatility increasing. So if we pick something with a really low implied volatility, the probabilities are that that volatility is going to increase down the road, right? I mean, if we look at something like Apple with the volatility, as you can see, heading into earnings for one, volatility increases. So you want to try and pick it when it's below an IV percent of 50. And I'm going to go into that in more detail as well. Or you expect volatility to just really start increasing. And one of the best ways to figure out if volatility is going to increase is when it's at its lows, because it's going to have a probability to revert back to the mean. Same, for instance, if you're at really high implied volatility, it's going to have a probability of decreasing back to the mean. So that's what we're looking for, is volatility to increase to hold that market move off. Because if volatility decreases rapidly, and we had that volatility increase, volatility is going to decrease. And if it even pushes lower and lower, it's going to make it decay even faster. So it's going to kind of do that. Or if we got into this trade and volatility decreased, it's going to make that slope happen like that. Because remember, when volatility is high, premiums are high. So as volatility comes out, it's like letting the air out of this balloon and the premiums come out, so that it's going to feel like that decay happens faster, and it will decay faster. So if we get into it when it's low, those premiums increase. When we get into it high and it comes out, those premiums decrease rather rapidly. So we don't want to ever see that happen. All right. And picking the right environment, I mentioned this, and I can't probably mention it enough, especially with this long call spread or long call, is we want low volatility, and we expect to see volatility to increase. All right, going forward. So we want to pick the right environment. This is really important. And now, when I give my rule for this, I am looking for something with an implied volatility percent of below 30. All right. When we're selling strategies, we look for really high. When we're buying, especially the long call, below 30. And I would look at the ones that start out with 0 and then go from there, you guys. Start out as low as you can. And please do not make the mistake of doing this with an implied volatility percent of above 50. And one way to figure out implied volatility percent is you take where you have a numerator and a denominator. So in the numerator, which is on the division table on the upper side, the denominator is on the low side. We're having two sums we got to figure out, and then we're going to divide those two sums by each other. And in the numerator, we're going to take where it is currently now. So let's just call it 20. 20 minus the low, which is 10. So in the numerator, we have 20 minus 10, so 10. And we divide 10 by the high, which is 30, minus the low, which is 10. So 10 divided by 20, and that gives us 50. Now, that was me ballparking that in my head. Obviously, you can see it's 47.3, but to do that in my head for government work, that's pretty good. Now, another reason why you have to know that is because let's look at something like Yum Brands, where it's something really wanky. You might need to take that out of the equation, whatever was happening here, bird flu or who knows. But that's going to give you a false reading in a sense. Or you could look at something like Priceline. Now, why is Priceline's not coming up? Well, because there's a break in this chart. So the algo can't figure it out for you. So you need to be able to know that so that you can figure it out. Also, there's going to be sometimes where there might be an extreme outlier, and I can't think of one right now that might have an extreme outlier. Maybe one of the stocks here does, but it doesn't seem to. But, you might have this massive spike out of line that creates a real strange trend. So I can't think of one that has it, but so you might want to cut out maybe that high spike, because a lot of the biotech stocks will have it when there's a trial result coming out. It'll have higher implied volatility than in around an earnings. And when you get that, it's probably not going to happen for maybe another year or 2 years. So you need to know that math to take that out of the equation. All right. So, and then knowing our exit strategy. So with this, it's really going to be a determining factor. It's going to be based on how you trade. But make this rule according to your risk or your risk parameters and things of that nature. How you trade a stock, let's say. If you're using Fibonacci for a stock and you say, okay, well, Fib's going to go to this level. I think it's going to go to that support or that resistance area. That's where you would normally get out of the stock. Same thing here, okay? I usually look at it like when it goes up and tests me on that stock. So I'm trying to pick those stocks where I'm looking at the probabilities of being tested on it. So if it goes up and I make that 80 cents on the option premium, I'm getting out. The reason why is because I know the probabilities. I talked about those probabilities. Remember, the probabilities of being in the money are half the probabilities of being tested on this particular strike. So I'm going with a higher probability of success, and that higher probability is in and around being tested on it. So I'm going to be looking for something like that. Or sometimes I will think, it's going to go to this resistance level or look at something on the chart. But write that down. This is really important, you guys. Whenever you're knowing your exit strategy, write that down on a piece of paper. I can't tell you how many times I have seen people, traders, like lose on positions that were winners because they were like, oh, that was easy. It happened in like 2 or 3 days. It's got to go further. Well, no, it doesn't. The probabilities are the probabilities. So look at that delta. Know your probabilities of success. This is a lower probability strategy, less than 50%, right? My probabilities of being tested are much greater, and that's why I'm going to go with that move to get tested on that particular underlying. But once you write it down, don't change it. If you don't write it down, you will have a tendency to bend wherever your exit was that you originally thought. You might go up and test that resistance area and blow through it for a second. And you're thinking, oh, now it's going to act as support. Well, listen, get out of it. You know, one thing we used to say on the floor was bulls and bears can make money. Pigs get slaughtered. And if you stop abiding by your rules, you will get slaughtered. All right. It may work a couple of times, and the problem will be that it will not work more often than not, and that will make you not profitable. So stick with that rule, okay? We're looking to swing for, singles, doubles, and triples. I'm not going for a home run, all right? Which some people will look to do with a long call spread. But I'm always looking to manage my risk, get in and get out of these things as quickly as possible to increase my probabilities of success. And that's really important. All right, so let me get through a couple more of these. I know I'm probably boring you guys to death with all the rules, but max profit is unlimited. We're not looking for that, all right? We're looking for our target to be reached. We're writing that down on a piece of paper to stay mechanical, all right? If you let yourself not be mechanical, you are letting yourself be set up for failure, all right? So we're looking to get out when I write it down. I have like 5, 6 spiral notebooks here, and basically I write down every single trade I do, you guys. Write down the date, the trade I do, why I got into it, and more importantly, where I plan to get out. And that keeps me mechanical. That keeps me following that. I stay to it, and that's what's allowed me to be a trader for over 25 years. Okay, so stick with that. All right, max loss is always that net premium paid. Anytime we are paying a debit for a strategy, any option strategy, that's the net premium we paid is our max loss. So that's the beauty in that. We know our risk. The break even, though, is going to be that long option strike plus the premium paid. So when we were looking at something like, what did I have up here? We can look at GLD. If I were to look at that 45 to 35 strike, I'd probably be looking at this 41s because that's what I can pay about $1 for. So I need this underlying to go to $73 and 94 cents, so almost $74. So that needs to be taken into account. It will increase, and that's only at expiration, you guys. That's the break even for expiration. If this were to move up here in the next few days, we're going to decay by about 3 cents a day. So let's say 10 days, but I got $2 move. I'm going to be increasing my profit, or this will increase by the 40 cents, the first dollar move, and the 50 cents, so 90 cents on that second dollar move. So if this comes up and tests me in the next few days, I'm going to see about an 80-cent profit on this, which is a nice win. Okay, so I get a $2 move. That's going to be a nice trade. Okay, and that's probably where I'd be looking to get out. But that break even is at expiration. It doesn't have to do with this moving in the next few days or so. And of course, this would not be the strikes that I'm looking at. I'd be looking at outside of 45 days. So same rules apply. I would be looking at somewhere in and around these two. So the 75 strike in this case. And then if I got that $2-3 move in the next few days, I'd be up by about that same 90 some cents. Okay, does that make sense for everybody? If I'm buying the 75 strike here, the first move is that 30 cents. So we've got almost $3 a move here, right, to get to my strike. So $3 a move. The first strike is going to be 33 cents. The second dollar move is going to be worth that 33 cents plus the gamma. So let's call it 40 cents. So I've moved up a total of 70 cents. And then that next dollar move is going to be even more so. It's going to be probably another 50 cents added on to that. So another, $1.30. So this will go from $1.20 to $2.50 on that. And that's what I'm looking for. Another $1.50 I'm going to be getting out of it. I'm not going to worry about it having to go to $76.20 to get to my break even. That's at expiration. That's after all the theta decay has happened. So we're just looking for that move to happen really quickly. That's why I said we're really bullish on this. All right, so this is basically the time of the webinar where I throw it out to you guys, throw out some stocks that we'll look at, and we will see if it fits my rules. All right, we want volatility to expand. We want this to start moving higher relatively quickly. Okay, XOM. Let's look at XOM, ExxonMobil. That's a good one. If you're bullish on crude oil, the higher crude oil goes, the more profit these guys are making. It's up close to 60 right now. So, these guys are actually starting to be able to make money on fracking. They've been fracking in the past, but losing money on it. But it's cheaper to lose money, believe it or not, on the fracking operations. They just really slow the pace a lot and lose a little bit of money than shutting those operations down and starting it back up when they would be profitable. So they'd rather lose a little bit of money on the margin to keep those operations going in the expectations crude oil will move higher. It's starting to move higher. They should be able to make some money on those. So first rule we look at, we're going to be looking at, picking the right underlying. Right underlying would be, 10 cents wide to the bid ask. ExxonMobil meets that rule. We can see that these are well inside of that, 2-3 cents wide for a stock that's under $100. So that fits that rule for the bid ask. Next thing we really need to look at is the implied volatility percent. And one of the beauties with Thinkorswim is that it gives it to you. So it's 41. I would have to expect volatility to expand quite rapidly in order to be able to keep up with that. But 50 is right around the mean, right? So and as you'll be able to see on a chart, that volatility rallies up and comes back down, and goes down and comes back up. So we would want to try and catch this when it's pretty low. And I would expect, as you can see in the past on the earnings, you get the volatility crush. It ramps up through earnings, but that's about midway through. And right now, and it gets a bit of a dip right in this area that we are. So I would expect maybe we would see a little bit of a dip. So I think that probabilities of it expanding anytime soon are probably less than it going down, just based on past moves of volatility. So I would stay away from this particular one based on the high implied volatility. All right, somebody threw out Cisco. I haven't traded Cisco in a long time. Cisco just made an all-time high, or actually it's not an all-time high, don't get me wrong. I remember when Cisco was traded in 300s. Let's see. So what's the implied volatility percent? 50. It's probably going to go down. Now, you could do this heading into earnings, but Earnings have just happened. Now, yeah, we could say because the earnings are past, we should ramp up into it, but I would have a tendency to say that it just happened. The only way we would really, at this point, get volatility to expand would be to see a sell-off. Now, volatility has a tendency to increase more often when you have a market sell-off than a market rally. All right. So in market rallies, one thing we have to be really aware of, especially with the long calls, is that we have really low implied volatility. The puts, if you get your market direction, volatility will expand almost no matter what. This, you get your market directional assumption correct, volatility very well could come out. And it's not to say that once it's low, like in these teens, it's not going to go even lower, but the probabilities are, if you're at a very low probability, like let's just look at win, for example, you're at a very low implied volatility. It has a tendency to bottom out here. So as long as it doesn't really go down a lot, we're good. And it doesn't look like it has much room to move to the downside. As you can see, even in these market rallies, this has been a tendency to bottom out here at these areas. So I'll go with that as an example of where we're looking for a low implied volatility. The lower the better. But I'm bullish on win. I think that as the economy starts doing better, let's just go through some thought processes that I would write down here on my book. As the economy does better, which we've been seeing pretty good economic data, a lot of people have more disposable income. One thing that even solidified this even more is if we saw wage inflation, because then people would have even more disposable income, right? But as the economy starts going, more people are getting hired. They are going to have more disposable income. They are going to want to go to these types of casinos and stuff. And Win has been doing really well over in China and Macau. So I think that this could even increase that even more. There was a time where they were really worried about how much they could get out of the ATMs and stuff like that. I think that's past us at this point. So bullish on Win. A lot of times, to be honest, I would like to see a nice market correction before I threw this on with low implied volatility, or it wanted the idea to migrate back to one of these point of controls. This is Jody's asking, what is this on the side? This is called market profile, is what we used to call it on the floor. There are monkey bars in here also, but there's time and volume. And what this tells me is, remember I told you I have a psychology degree, and it's a minor, but one thing this tells me is the psychology of the market. It tells you where people are putting their money where their mouth is, where this is where the most volume has been traded. So this is where the most people have transacted, and this is where the most time has been spent. So I usually look at when they're separated, this as being the more what's the word I'm looking for? The one to look for, because this is where people put their money where their mouth is. This is kind of where people have gotten complacent. This is where people have had price acceptance. Now, I don't really expect them to drop that much. They've had a nice big run, and this could be acting as a magnet. We're up against a resistance, so these are all the things I'm going to go through in my mind in order to determine whether or not I want to implement this strategy. But for time's sake, let's just say, it's got that low implied volatility percent, 7, as you can see here. I pulled this up. I actually went into the gears and put this in. I have the code for this, so you'd have to reach out to us. We give that out to our premium members, so you can add that code in there. Otherwise, you just need to look down here. But I use it in my watch list so I can easily find what everybody's implied volatility percent is, because that is what is going to ultimately determine any strategy I do. all right, according to my rules. All right, so yeah, you can reach out to us for that, Jeff. Okay, so this has low implied volatility percent, bullish assumption. We're going to look for like the 45, 35 delta. A lot of days out, once you get above $100 stock, you're going to have to pay up for these. So if you're not used to doing $100 stocks, also we might look at something a little bit lower, maybe like eBay or something. But looking for the 35 to 45 delta strike, I'm probably going to default to like the 37 strike. So those are the ones that I would go to buy. And one thing to keep in mind, when you go out to buy these, keep in mind that you go to buy this, it's going to default you, especially on the long calls, to the offer. Don't pay that offer every time, okay? Go in lower. I would even go in lower than mid-market, you guys, because it doesn't cost you anything to go out there and cancel, replace a trade. Put a bid in. Let it sit for a second. And I'm not saying let it sit in there for 5 minutes to get filled. If I decided I wanted to do this strategy, I'd go in there. I'd go lower than mid-market, probably somewhere around $3.63. And by the time I hit confirm and send, come back here, look at it, go back into the monitor, cancel, replace, go up to maybe 365 or something like that, put it in there. And then I probably would not go much higher than mid-market, maybe a couple of pennies. 367 or 368 would probably be higher. But if you go in there and just click on this to buy it, they're going to default you to 370. Yes, you are going to get filled, and you're going to get filled immediately. And one thing I say is when you get filled immediately, you hit that confirm and send, and all of a sudden you hear the bing, you got filled, or cha-ching, or whatever your thing is set up to do. You may have very well left money on the table, you guys. And yeah, it's only a couple pennies here or there, but over the course of time, those pennies add up. And as a matter of fact, if you can get it for better, then, those couple of pennies savings could actually be paying for your commissions. So it doesn't cost you anything to cancel replace. So get in the habit of doing that, having 2 or 3 cancel replaces to know that you got the best price. If you go in there and just pay up, you're leaving a lot of money on the table, especially over the course of your lifetime of trading. So somebody else did throw out eBay, so let's look at it. Rules we look at: under $100 stock needs to be tighter than 10 cents. That is the case here. We are well inside that. Now, where do we want to get out of this trade? A couple of things to look at. They've had a bit of a sell-off. They kind of took a big drop here. I think everybody still uses eBay. My wife sells stuff on eBay all the time. Maybe it's going to cover this gap or something. So look at a couple of prices or go up and test this value area high. I look at these kind of like some people look at Fibonacci. This is going to be a magnet. Yes, it's going to want to go down there. I think that it's kind of tested that 200-day moving average access support. It's tested that now, rebounding away. A lot of things to look at for me as a chartist. It's above the 9-day. That's a short-term bullish trend, so we want that. So we can even look at your Fibonacci. I'm just going to throw this up quick and dirty. I'm not going to try and get it exact. So that might act as resistance. That might want to make you double think this one. I think it, let's say, my assumption is it goes up to 38. So go back and look at our strikes. 38 is where I think it's going to go. 37 and a halves are the strike that are closest to that, 45 to 35 delta. Yes, it's a little bit less, but I got a 60% probability of being tested on these, so I'm good with that probability. So those would be the ones I would look to buy on this one. I don't really want to buy the ones necessarily that are in the money. You could. It's got a really high percent probability of being tested, 100% probability of being tested. Oh, that's because it's in the money, right? So that rule is good. So probability being in the money at expiration by 1 penny is only 54% though. So don't ride this into the sunset. So I'd probably default to one of these ones that's slightly out of the money, which is this 47.5 strike. Or sorry, 37.5 strike to buy that one. And again, I'm going to do this really small, I have a high risk tolerance, but knowing the probabilities of this strategy being successful, I'm not going to put a lot on the line. I'm just going to do it more so for my assumption and to keep me engaged. Okay, small price to pay to keep you engaged in the markets. I like to try and keep myself engaged. All right, so that's about it. Does anybody else have any other questions? I think I got everybody on the questions, and I see, yes, I did avoid some of the snark coming across on your things there, but anybody else have anything there? All right, so I'm going to throw a link in the chat window there that you guys can click on. We've been going back and forth on the questions box in the chat window. Is a little bit separate. I have a link to this particular offer, which is a really good one, especially if you guys have been watching rising interest rates, FOMC, better economic data. Interest rates are going to probably be increasing. Your portfolio in your bond portfolio is going to get crushed. Most people have about 50%, maybe a little bit less for some of you younger guys and gals out there. But that portfolio is low risk, but it is a lot higher risk than anybody is going to lead you to believe, even if it's an ETF bond portfolio, or even especially if it's an ETF bond portfolio, because those guys in the bond portfolio have to buy high and sell low, meaning when interest rates increase, the value of those bonds goes down. And yes, you can hold it all the way for 30 years and get your par value back for it. If you paid $100 for it, then you're going to get $100 back. But most people hold those bonds for 7 years, and these guys in the ETFs hold them for much less time. So if interest rates increase, those values of those bonds go down because people chase yield. And you can't chase yield. It's a losing game. If you're trying to get a higher coupon, it's not going to work out for you guys. You're going to lose money over the course of time trying to do that. The best way to do it is to actually sell premium in and around that. And I go through all the rules on how to protect your bond portfolio. So $36, this in and of itself is worth clicking on that link in the chat window. If you're watching this on tape delay, like we've sent it out to you, and you're just watching the second time like I suggested, to take advantage of it, pause the video and punch this into your URL, because you can't beat this deal. I mean, at the end of the day, trading with probabilities will increase your success, you guys, because probabilities are the probabilities. Last one of those we looked at was win, right? The probabilities are in the casino's favor, and that's what we're trying to do, is increase those probabilities into your favor. A lot of people don't understand that when they talk about not wanting to trade options because they just don't make money doing it. Well, that's because they don't have my rules. They've gone online. I know you can go online and read how to do these strategies, but they don't follow a mechanical set of rules to keep you in the game longer. And that's what I try to do. It's basically the rules I've learned on the floor from various people, mentors and things of that nature. Some of them that I've come up with myself as well. A lot of them I've come up with myself that I've learned I've been successful with, and that's what I'm sharing with you. So if you guys have enjoyed my instruction, especially if you guys are one of my regulars, you guys really need to get signed up for this course. And you have a chance to get it for, $36. And I mean, you'll make that money up by just protecting your portfolio. I can assure you of that. All right. So wouldn't you guys say that basically knowing how to create an option strategy by going online isn't going to be enough to create consistent winners? I mean, those guys online are not giving you those essentials to success and things of that nature, and going into that minutia that I have. So that's what I teach in all of these webinars. basically what I mean, technical trading. I do trade on technical analysis, but just trading on technical analysis and throwing a strategy on it isn't going to get you ahead in the game the way that trading with the probabilities in and around adding those other things that you're used to will. And becoming more mechanical, which is extremely important. And I try and beat that in there also. I mean, anyone can teach you how to build a strategy. No one else is going to show you how to set it up to increase your probabilities of success like I am. And I teach that in these, how to play probabilities. When the probabilities have gone against us, how to stay mechanical to increase those probabilities further in our favor, which is going to create ultimately alpha in your portfolio, you guys. All right. So when you're using the right tools in the right situation, you guys are going to be more productive state of mind, and you're going to be able to put on more strategies, which increases your opportunities, you guys, ultimately building your confidence, and that just snowballs into becoming a better trader. All right. Keep in mind, you do this trade the first time, it may very well go against you because those probabilities are against you. Don't let that necessarily, with all these different strategies, get you away from it. Keep in mind, hold solace in knowing that the probabilities are the probabilities. So if the probabilities beat you on this one, the probabilities are more in your favor down the way. It's just like in Vegas, if you go and do real well at those tables that first day and you crush it, what happens? The pit boss comes up and, hey, go get yourself a dinner. Here, have a couple of drinks. Why are they doing that? Because they want to try and get those probabilities back in their favor by getting you to come back to the table. They might even give you a night stay in the hotel for free to keep you there, because they know that you're going to come back down on that floor and the probabilities will ultimately come back into their favor. That's why they do it, you guys. They don't do it because you're a great poker player. They're doing it because they are great odds makers in a sense. All right. So what do you say? Go ahead and click on that. Yes, it is. Sorry, it's in the chat window. We've been going back and forth in the questions box. It's in the chat window. This also can be written down if you're watching this on tape delay. All right. So take advantage of that. What do you guys say? Go ahead, click on that, and I'll start wrapping this up. In later webinars, I'm going to be drilling down on different options components, how I trade the options, when and where I find options appropriate. I also talk about every single trade, you guys, in my daily market commentaries, which comes with the premium membership. It's not really that one that we're offering there. You can reach out to us to find out more about that as well at 310-598-6677, or you can email us at trading@protraderstrategies.com. Again, you can pause the video here and write it down if you haven't clicked on that in the chat window, or if you're watching this on tape delay. But I see a lot of you guys are clicking on that, so that's good. All right, so this is a great one. Also, it gives you a little bit more detail about using gamma, how to take advantage of theta decay, odds of winning your trades, a lot of those things. Really good one about Malise from Theta, and he's the first guy to do options. I think it was Aristotle even wrote about him. Talk about that. So a lot of fun ones in here as well, and there's several more. So this is like, we're looking at 15 hours worth of videos that you can watch. And it's really set up real nice. Basically, there's going to be a little window next to each one of them, and you just kind of click on it and check it off that you've watched it. So for $36, you can't beat it. All right, guys, that's all I got for you guys today. Thank you very much for participating in this. Love the feedback. If you have any questions, reach out to us, like I said, at 310-598-6677. Yeah, Joe, the daily market commentaries are separate from this, but reach out and these guys will get you set up with that as well, because those are about as important as these daily market commentaries, you guys. The daily market commentaries are about as important as these webinars, because I go through every single trade I do. And when I talk about the winners, the losers, and how I'm managing those losers, You know, the guys out there that cherry pick, they just show, hey, you know, if you would have done this butterfly here and got out here, you would have made 200% increase in your da 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 da. Well, I don't do that. I talk about that stuff when they are winners and what those increases are, and I talk about how I'm staying mechanical, getting in and out of these trades. And when they go against me, I'm not cherry picking trades. The day I put them on is the day I tell you in these market commentaries. The day I take them off is not always the day I take them off necessarily, and I can't say necessarily the day I put them on, because if I put them on in or take them off after the daily market commentary, I obviously have to talk about that the next day. But it is real time that I'm doing these in, and in those daily market commentaries, I'll tell you, hey, I'm working to get out of this particular one. I've got a working order and stuff like that. So, or I'm looking at putting this trade on. And for the earnings trades, I follow those rules and do those towards the end of the day. So I talk about those the next days as well. But I do tweet those out to give you a heads up. But I talk about every single one. So if it's a loser, I'm telling you what I lost on it. All right. If it's a winner, I'm telling you what I got out of it for a winner for. And if it's a loser, I'm talking about how I'm managing that. Like, I've turned several trades. I know a couple of you guys been in these webinars several times. I recognize you guys, and I appreciate you guys, your participation. But I don't know where I was going with that. The daily market commentaries. Anyway, they're really good. So I don't cherry pick them. I go through all of it and how to stay mechanical with it. All right. Oh, I know what I was going to say. A couple of those that I've turned out from big losers like Twitter, IBM, and a couple of other ones. SPY, I turned into a winner that was a big loser. So by staying mechanical with it. All right. So that's about it. So check out those daily market commentaries and make sure you check out this deal. It's a really good one. That's all I got for you guys today. If you can't take that, take it easy.